Hello everyone, this is Jeevakan. In today's video, we'll be looking at whether a stock market is overvalued or undervalued. For that, we'll be analyzing Nifty in detail. So whether we retail investors should be considering it as a buying opportunity or a selling opportunity. We'll just analyze certain facts to conclude that. So let's get right into the video. First of all, everyone would be really confused right now amidst these volatile situations because markets have been acting quite weird lately. Because one day there is a huge gap up, another day there is a huge gap down. So everyone would be really confused whether to buy, hold, or sell their underlying shares amidst these volatile situations. What I feel is it is a great opportunity for investors to accumulate some good stocks. So why I feel this is one of the best opportunities to accumulate stocks. For that, we need to look at certain factors in order to conclude that. The first factor is we need to look at the PE ratio. The PE ratio of Nifty right now is 22.7. Basically, what a PE ratio tells is, it tells us whether the stock or an index is undervalued or overvalued. Usually, a low PE is considered as a buying opportunity and a high PE is considered as that the stock or an index is overvalued. So let's analyze the historical Nifty PE data right now. We are looking at Nifty PE ratio chart right now. Current PE ratio of Nifty is 22.7. Interesting thing which we need to have a look at here is, even during the worst fall during March 2020, the PE ratio fell down to 21.38 and Nifty was available at 7,500 levels. But now Nifty is at 17,000 levels and the PE ratio is just 22. Why is that? PE ratio is the same when compared with March 2020 and April 2022 levels. But Nifty then was at 7,500 and now it is at 17,000. This phase between March 2020 and May 2022 gives us a lot of insight about the economy. Now we are looking at the entire PE ratio data of Nifty in a tabular format. Key thing which we need to note here is that during the small phase between March 2020 and April 2022, the PE ratio went to a high of 41 during Feb 2021. But why it went to 41? So what happened in Feb 2021? In Feb 2021, lockdown was imposed and all the businesses were underperforming at that time. Yet stock markets were rallying like anything because of the huge money pumped into the market. Because of this major reason, PE ratio was really high and it literally meant that the stock market was really overvalued at that time. But what's the status in April 2022? In April 2022, no lockdowns were imposed and all the businesses are reviving and starting to do well. And yet Nifty has corrected almost 10% from its all-time high. So currently Nifty is available at discount and is available at reasonable valuations because it has corrected almost 10% from its all-time high and it can be considered as a buying opportunity for investors. Looking at the PE ratio of Nifty, we can conclude that this is one of the best opportunities to accumulate stocks right now. The PE data clearly shows that the Nifty is undervalued right now. The next factor which we will be looking at is the FII selling. FIIs are the foreign institution investors. These people are players with big money who has been selling continuously for the last 1 year. To be honest, no one knew the exact answer on why the FIIs have been continuously selling for the past 1 year. So let's closely analyze the FIIs buy or sell figures for the last 1 year. Now we are in money control where we can track the FII activity for the last 1 year. So almost every month they were net sellers. They sold 40,000 crore in April, 43,000 crore in March, 45,000 crore in February. But only in September they were net buyers for 913 crores in the last 1 year. Selling never looks to reduce over the months. It only got increased over the months. It's only because of the DIAs and the large money pumped by retail investors like us, the markets were stable right now. Even during Corona fall of March 2020, they sold for 65,000 crores, which is actually the highest by FIIs. But now they are frequently selling for 40,000 crore plus every month, which is quite weird. Looking at the FII data, if FIIs start buying again, there will be a huge rally which will be coming up in the stock market. And we can see some blue chip stocks like HDFC Bank, Infosys, and these stocks would be rallying like anything. And the third factor which we'll be looking at is some specific sectors are facing some aggressive selling. Sectors like banking and IT are the main sectors. When we speak about banking sector, the main stock which we'll be looking at is HDFC Bank, because HDFC Bank plays a major role in the underperformance or the overperformance of Nifty because it has the highest weightage in Nifty. HDFC Bank has been under the radar for a while because of its merger news which came lately. It has been going up 15%, coming down 20%. It has been around the news lately. It has been highly volatile for a few days. Looking at the HDFC Bank data, the best bank in India is HDFC Bank, and looking at its data, the PE ratio of HDFC Bank is 20 right now, and the 5-year median PE of HDFC Bank is 27.6, which means it has a lot to catch up to. And one more important thing is FII's favorite stock is HDFC Bank. And if we look at the shareholding pattern, FIIs have 35% holdings in HDFC Bank, and they have been selling it aggressively for a while now. But once they start buying, there will be a huge rally which can be seen in the banking sector. And coming to the IT sector stocks have been underperforming for a while now because of the bad quarter they had. When it comes to Infosys had a bad quarter and it did not meet the street expectations, and it fell massively. It fell almost 10% from its all-time high. And the second most important factor in IT companies is the attrition rate. Attrition rate of Infosys is 27.2, which is really high. And the attrition rate of TCS is somewhere around 17, which is also really high. So what attrition rate actually means is that, so 1 in 4 employees of Infosys has been going out to find new opportunities in other companies. So this is a bad news for a giant IT company like Infosys or TCS. But these are all short-term fluctuations and it would not affect a giant IT company like Infosys or TCS. Obviously, it is expected to outperform in the coming days because it just had a bad quarter, and obviously we can come to a conclusion that it is not a bad company. And the last factor which we'll be looking at is analyzing Nifty from the technical perspective. We can come to a conclusion that Nifty has given average returns for the last 3 years. So let me show the chart right now and show you how much returns it has given in the last 3 years. And we can come to a conclusion whether it has given massive returns or decent returns in the last 3 years. Now I've opened Nifty monthly chart. So Nifty had this huge breakout after Corona fall, breaking all these strong resistances. The important thing which we need to look at here is that from May 2019 till date, Nifty has given almost 41% returns, which is pretty decent in stock market. The average returns per annum was just 13%. The worst thing that could happen right now is Nifty could correct to this trend line of 15,000 to 15,500 levels, and the next huge rally will start. Ultimately, investors should hold tight right now and hold for the long term. Because 2003 to 2008 saw a huge bull run where we had a 600% move in Nifty in 5 years time, which is an average of 110% returns per annum. Compared to that, current returns which Nifty gave in the last 3 years is nothing. We have a long way to go in the upcoming years. So Nifty has given just 41% in the last 3 years, which is decent, not great, not bad actually. These 4 factors clearly shows that Nifty is undervalued and it has a long way to go upwards. So if we use this opportunity to buy some good stocks, obviously we'll be getting benefited in the long term. So that's it. Thank you so much for watching the video. Signing off. Until next time. Cheers.